Hi, I'm Clark Kent, and there are two things that are common between me and a systematic investment plan. Firstly, we both have very uncreative names. And secondly, for both of us, our destiny is to be average. And so in this video, अच्छा, thank you जी, ये dry clean भी करा दिया, चलिए, thank you. Alright, so where were we? Yes, so a systematic investment plan helps an investor ride out the ups and downs and averages performance over a period of time. It's a very popular and hugely effective strategy, and it's something I practice when investing in equity instruments, especially mutual funds. Now, I won't get into specifics of what is a mutual fund, how does it work, etc. I'm sure there are many YouTube videos on this subject. So instead, I shall be discussing some strategies, some techniques that you can layer over your SIP that have the potential to visibly improve your returns. Or as Superman would say, up, up and away. Let's begin. Now, I'm sure you've heard of a step-up SIP, but just to brush up, a step-up SIP is an accelerating plan where the investor gradually increases his or her SIP amount over time. For example, say you've set up a monthly SIP of 10,000 rupees. Now, one way of stepping up is to assign an absolute amount. So if you agree to step it up by 2,000 rupees every year, then your monthly contribution will be 10,000 for the first 12 months, 12,000 in year 2, 14,000 in year 3 and so on. So this is one way, and the more common type of step up that you'll find in most websites is the percentage method, where the investor raises his or her SIP by a certain percentage every year. Now, assuming this is 10% in our example, the investor would put in 10,000 a month in the first year, 11,000 in the second year, 12,100 in the third year and so on. This is definitely no rocket science and it won't make you a Superman, but should you be doing a step up SIP? Well, in my opinion, and as many of my superhero friends would say, yes. The next type of SIP I want to discuss comes in different names. Someone calls it value SIP, someone says alpha SIP, or smart SIP, flex SIP, booster SIP and stuff like that. But the core principle is more or less the same, that is, invest more when the markets are down and pare down your investments when the markets are expensive. Of course, this process is supported by some model or algorithm, but if we understand it broadly, what these guys are saying is that SIPs have a fatal flaw in them, which is this process of investing a fixed amount of money every month does not take into account any additional information that the market is generously providing. For example, if the Nifty were to drop by 15% tomorrow, then there is no way you are going to keep quiet and you would be gearing to invest some more money when the markets reopen the day after. So that's some additional and crucial information that an SIP misses out on, which has prompted fintechs and AMCs to build and market a solution around it. The solution is in the form of a model or an algorithm that sits on top of the SIP and decides what needs to be done next in terms of buying, selling or rebalancing, which can enhance an SIP's return on a risk-adjusted basis. For example, ICICI Prudential recently launched something called a booster SIP, which, as one can expect, comes with two additional layers over a traditional SIP. The first layer is a proprietary equity valuation index model, which informs the SIP when equities are expensive and when they are cheap. And the second layer is a variable amount setup that transfers an amount ranging from 10% to 1000% of the SIP amount depending on what the EVI model says. For example, let's say equities are super cheap and our base SIP installment is 10,000 rupees. So per this setup, the fund house can invest up to 1000%, that is 10 times of 10,000, that is 1 lakh rupees. And if equities are super expensive, then that number may be pruned down to just 10%, that is 1,000 rupees. To equip this process, the booster SIP works on a source fund target fund concept, wherein an amount is first transferred to a source fund, which is generally a short duration debt fund, and then this amount is transferred to an equity or hybrid fund of your choosing, which is the target fund on which the EVI model is being layered. So do read up more about this, but on a performance basis, when ICICI Prudential ran this booster SIP over the Nifty 50, the Mid Cap 150 and the Nifty Small Cap 250 over a 17-year period, they observed a 1 to 2% lift in the CAGR. I also looked at Kotak Mutual Fund's Smart SIP, which works pretty much on similar lines, where the monthly SIP amount is determined based on Kotak's BAF net equity allocation model, which flags the market as cheap, neutral, or expensive. While Kotak applies default min-max values of 50% and 200% of the SIP amount, investors can modify these numbers to some extent. The major difference I found between Kotak MF and ICICI Prudential's offering was more on the construct. So where ICICI uses a source and target fund concept to divert the money, in Kotak's case, it's the actual SIP amount itself that changes. You can read more about this on the internet, and while you do so, also check up on HDFC Mutual Fund that has something called a Flex SIP, rankmf.com that offers a smart SIP which buys, sells, and even skips SIP installments, and there's also an Alpha SIP that is available on finpec.com. With Indians catching on to SIPs in a big way, I have a feeling this trend of adding functionalities and features on top of SIPs is going to continue for many more years, which is a bit strange because the classical premise of an SIP was about not timing the market and to invest irrespective of market conditions. But you know what? Investing has been and will continue to be an evolutionary process, and in my view, it's always good to keep one's eyes and ears open and to learn something new even if we don't implement it. Alright, so how about doing all this smart SIP stuff by ourselves? Well, it's a rhetorical question because that's what the rest of this video is all about. I'll be covering two DIY strategies in this section. The first one is based on relative valuation, and it's something I covered in my very first video on this YouTube channel. So to quickly recap, I pulled out monthly closing values of the Nifty Small Cap 250 TRI and the Nifty 50 TRI index from the website niftyindices.com. I recomputed the numbers based on the 2007 base value, leading me to a relative score. I then set up a number of scenarios to see how much higher we could go in terms of returns. And looking at this table, I would say mission accomplished. For more specifics, do check out the small cap video and the Excel worksheet that's available in the video's description. As a follow-up, I also tried to replicate the exact same process with the Nifty Midcap 150 index, but the alpha I received was a bit of a suspect, which probably means I have to look at the midcap problem statement in a different way. Anyways, going back to the small cap strategy, I also looked at taxation this time around, and as I thought there was not much of an impact, and the relative valuation SIP strategy was able to generate good alpha on a post-tax basis. The second DIY strategy I want to discuss revolves around market valuation, and more specifically around the P ratio. Now, the smart SIPs we discussed earlier, ICICI, Kotak, HDFC, etc., they claim to use a number of factors in the modeling, which is probably true, but I think the P ratio is the primary basis of it. And this is the factor that we'll be working with when testing our version of the smart SIP. So here's how it works. Our monthly SIP investment will be to the tune of 10,000 rupees, and we shall be examining performance from January 2007 until December of 2022, which is a fairly long period of 16 years. The 10,000 rupees will be invested in the Nifty 50 TRI index, and based on where the Nifty 50 P ratio is, we'll either add some money or we'll redeem some of it. But before we ran multiple scenarios, I also ran a base scenario and found that a regular 10,000 rupee SIP in the Nifty 50 from 2007 till 2022 would have given us a CAGR of exactly 13%. So that's the number we are trying to beat, 13%. Okay, now let's come to the P ratio part. And the idea here is to create bands that can help us understand what's normal, what's cheap, super cheap, expensive, and super expensive. My approach here was to keep one rather thick band in the middle with thinner layers on either side. So for our experiment, the thick P ratio band is between 18 and 24, which kind of makes sense because the Nifty's long-term average is at about 21. In other words, if the Nifty P ratio is between 18 and 24, we simply continue our SIP of 10,000 rupees without bothering about adding more units or redeeming a few. But when this number goes above 24 or drops below the 18 mark, we then activate different buy and sell actions depending on where the P ratio ends up every month. I hope everyone understands what's happening here. We are merely playing the odds and adding more units when the market seems undervalued and redeeming units when the markets are overvalued. In fact, I am reminded of a table in the 10 commandments video where I presented some data on how the Nifty has fared at different P ratio bands over a 1, 3 and 5 year period. Alright, so I tried out a total of 5 scenarios in our case. The first scenario is our base scenario, that is, I invest 10,000 every month irrespective of the P ratio, and this gave us a 13% return. Scenario 2 is where I invested 10,000 rupees in only those months where the P ratio is 22 or lower, which is a way of saying that I'm keeping my SIP on hold in those months when the Nifty seems too expensive. Scenario 3 is where I invest in all P bands. However, when the P ratio falls below 18, then I increase my investment on an accelerated basis. What I mean by accelerated basis is that when the P ratio is between 16 and 18, I invest an additional 10,000 rupees over and above the 10k SIP. Similarly, when the P is between 14 and 16, then I invest even more money and so on, which means the lower the P ratio goes, a higher investment will go towards our corpus. Scenario 4 is an extension of scenario 2 where I invest 10,000 when the P ratio is at 22 or less, but in case the P ratio goes above 22, then instead of holding my SIP, I actually redeem 10,000 rupees worth of units, making it a buy-sell transaction. And finally, there is scenario 5 where I employ an accelerated buying and selling structure at different P bands. So when the P ratio is at very cheap levels, let's say at 11, then I'm ready to commit a total of 50,000 rupees for that month. But when the same P ratio becomes super expensive, let's say a P of 30, then instead of adding capital, I am more than happy to withdraw some money from my portfolio, which in this case comes to 40,000 rupees. Now, when I am saying it, this might sound a little bit complicated, but believe me, this is just an Excel sheet at play, and for your benefit, I have attached the master worksheet in this video's description. It's downloadable, all the formulas are open, so please feel free to play with the numbers and see what works for you. Alright, so I tried these scenarios and presently all 4 scenarios, that is 2, 3, 4 and 5, were able to outperform our 13% base case, which kind of supports the argument that building an intelligence layer or two on top of an SIP does give it the super ability to improve one's SIP returns. Now, when it comes to the implementation, actually even before the implementation, it's probable that some of you would have made up your mind that this cannot be done and you're very happy being Clark Kent. But if I break the task into smaller steps, then here's how I would do it. Number 1, on the 1st of every month, my Google Calendar notification would prompt me with a message that reads, check Nifty P ratio and invest redeem accordingly. Secondly, I'll go to niftyindices.com, input the dates and figure out the previous month's closing P ratio. Point 3, I would open up my table of P ratio bands and figure out the action required. Then I'll log on to my trading account. And finally, I'll buy or sell the related number of Nifty ETF units. All this would have taken me a grand total of 6 minutes, which is not a lot of time and effort, especially when there is potentially 1 or even 2% to be gained. I mean, look at it this way, the regular SIPs we've been doing so far are like regular plans. And by tweaking that approach, we can get a direct plan-like returns from your SIP. 1% makes a lot of difference over the long run, so check out the worksheet. Feel free to modify it as per your comfort. Watch my video on small cap investing. And if you like what you see, then give this approach a try at least for the next 2 years. You don't have to commit a massive amount. Even 1,000 rupees a month will do. But the idea is to try out in the real world and see how it goes. I wish you the best and I'll see you next week. Until then.